Hello, good day everyone. Welcome back to another episode of Spark Your Fire. Camera's on, Friday's on again, Friday mode. But just before we start the Friday mode, we do have our recording to go through. John, good to see you here again. What's been
Likewise.
happening?
Oh, just living the dream, David. St still active in property, although things slowed down at the beginning of the year, really. But everything's good. Yeah, everything's good. I would actually say, interestingly, not to launch right into it, but the budget, as sort of adverse as it was, and I'd refer our listeners to our previous podcast where we talked about the budget. It actually did give clarity. So. As much as I thought it was unfavorable to real estate. My business is more active now than before the budget.
Good.
So that's
Yeah.
markets like clarity, don't they?
You must have, I think that certainly like disregard whichever direction the federal budget was
Yeah.
going. I think what people needed is just that level of clarity.
Yeah.
What exactly is going to happen? So at least they can plan and pivot moving forward.
Yeah.
So,
Yeah.
well, it's good to know. It's good to know that it's obviously giving you a bit more work and in your return.
Mm.
So it's been great.
Yeah.
Um, but yeah, we've covered the budget pretty comprehensively last time, I think. Yeah, definitely for those who haven't actually tuned into it yet, I would say I'd recommend to go and listen to it. John's given a lot of good advice in that episode and provided a lot of further clarity as well in terms of how we think that it's going to move forward. So one to check out if you haven't yet already.
How are
But
you doing?
today, John, we've got you back on again, as always, and we've got one of our ongoing recurring topics, the goal to price ratios, which, we've been doing this for about 2 years now, probably a bit over
Mm.
two, as a matter of fact.
Yep.
And we do this pretty much on a 6 monthly basis, just so that we can see the trend and analysis as well. So last time we did this, I think was around October last year, so it was overdue a little bit. But we John's kind of waiting for the April data to come out as well, so it gives us a good
Yep.
6 months in terms of where it leads up to. So the data right now goes up to, is it end of April? I think it was.
End of
That's
April,
what you
the
got.
latest
Yeah, so
data. Yep.
End of April, and we got to follow the same format as what we normally do. So we'll obviously talk about the Sydney to property prices. We'll talk about Sydney to gold ratios, and then we use that as the pivoting point for Sydney to be the main anchor, and then have the other capitals comparing to it, basically. So as always,
Absolutely.
I'm pretty sure I'm looking forward to this. I'm sure there will be some interesting
Mm.
trends. Now, for our listeners, what this doesn't cover is the federal budget impact at this stage, okay? Because by the end of April, the market was still humming along, although I'd say probably had a bit of sentiment change because I know, a couple of months before the federal budget, there were already rumors talking about potential changes to negative gearing, potential changes to CGT. So that may have been baked in a little bit, although I'm
Yeah.
not too sure how much impact it is. But the real effect or the real impact of the federal budget that's being announced earlier this month in May will only show probably in the next 6 to 12 months. So I guess by the time
Correct.
when we jump on this call again next time, we will have a lot more to be able to share and tell with everyone.
Yep. No, quite
All
right.
right.
Quite right. Should
Awesome.
we
Well,
jump
without any
in?
further ado, let's jump in, John.
Let's do it. All right. Everyone's favorite property analysis. All right. I'm going to share a deck and we're going to go through these one by one. Um, just a tick. All right. Okay. Um, okay. So we'll start with just nominal house prices. And by the way, this is house prices, not dwelling prices. So anyone who's observed the Sydney market over the last, say, 15 years would probably agree that house prices have done actually quite well. Apartment prices not so well. All of this data is, even when we compare it to gold, it's all about house prices. And house prices, particularly in Sydney, have done a lot better than unit prices. So it's
Mm.
just houses. But look, this is a property that a chart that we put up before, but this is updated to April. So we can see, look, uh, just you can see that like property does what people think property does. It tends to go up. There's a couple of corrections, but the obvious, two obvious sort of observations. One is that property market corrections are quite brief. We can see all these V shapes here. There's even in 2008, where it did sort of stagger along to 2012. it was still like relatively brief when you zoom out. So that's the first thing to note. Like we've got 2008 crashes, we've got down here, 18, sorry, we've got COVID, but they all resolve themselves fairly quickly. That's the first thing. Second
Yeah.
thing is that, and I say this every time, it's like up to 2008, the property market was pretty boring. Look how smooth that line is up until about here, right?
Mhm,
And
mhm,
then GFC happens and central banks get really active. You could say it's probably even to 2001 with the September 11 attacks, where the central banks around the world became unnecessarily activist. So
mhm,
any problem out there was could be solved by low interest rates. COVID could be solved by low interest rates. Um, GFCs, September 11, all these sorts of things. And so the result of that is quite a bit more volatility in the real estate market than you would expect to see normally.
yeah.
So Sydney house prices since 1979 up to April 2026, anyone who's invested has done well. And look, we're going to go through all sorts of things. Budgets are going to be good, budgets are going to be bad, interest rates are going to be up, interest rates are going to be bad. But real estate is just going to keep doing what real estate does. So it's always good to zoom out. Real estate's pretty solid, and there's been rising incomes. If you're an investor, you were getting rents this whole time as well.
Yeah.
Should we move on to the gold?
Yeah, sure. Yep.
I've already hit the button. Okay. But slightly more interestingly, this is what Sydney house prices divided by the gold price in Australian dollars tells us. Now, why do we want to do this? So I have to sort of explain why we price things in gold. But fiat currency, and since Bitcoin, everyone knows what fiat currency means. So it's sort of like mandated national currencies don't really have any intrinsic value. Ask anyone from Zimbabwe or Argentina what their national currencies are worth, and they're constantly leaking value in this process that we call inflation. So inflation kills national currency. So if you want to know what a house was worth in 1979 versus what a house was worth in 2025, most of what's changing is actually the value of the currency, not the value of the house. The value of the house is pretty fixed. It's still on the block of land. The block of land hasn't changed. What's changing over time is the value of these units of our currency. So how do you sort of see through the leakage in the value of our currency, that our savings every year are being diminished, that the value of the currency is being diminished? And so what you want to do is you want to measure it in a more constant anchor.
Yep.
And the analogy I give every time, David, is like it's like saying, "Oh, how tall is John?" Well, one year John is 6 foot, the next year John is 7 foot, and the year after that John is 8 foot. And it's like John's height hasn't actually changed. The tape measure keeps changing, and that's what it's like measuring real estate prices in Australian dollars because the Australian dollar is never constant. To get around this, we measure in gold because gold's priced in ounces rather than like length or something like that. And when we look at real estate prices in gold and in a constant anchor, you can see gold is just going up, overvalued, and then it goes down to undervalued, and then it goes back to overvalued, and it goes to undervalued. And this is essentially nearly a 50-year cycle. And you can see it just bounces between over and undervaluation, which is what all assets are. The oil price is doing that too. Everything is doing this in when you strip inflation out.
Yep.
One more thing, and then I'll get you in on this. So, between 1987, when we deregulated the banking system, people could get loans, through to like last year, um, the gold price was, sorry, the Sydney house prices were trapped in this valuation channel, like a 40-year valuation channel between about 600 ounces.
Yep.
You can see it keeps clustering around there, maybe a little bit lower than where the line is, to 400 ounces. So between 400 and 600 ounces for decades, it was just bouncing. What happened at the beginning of this in 2025 is that house prices broke down
Mm.
and they've crashed from the 400 ounces to nearly 200 ounces. Now, we said this when we presented this last August, and we said that the next stop is probably going to be this collapse to 200 ounces. Now, a lot of that is an increase in gold prices, and gold prices are going up because our currency is losing value. But this is what's really happening. And this is why we all feel poorer over the last year or two, despite house prices going up. House prices are going up, and yet everyone's sort of a little bit cash flow poor. Everyone's got to be making these huge incomes, and no one has any money at the end of the month. It's because in real terms, the money is worth less. In real terms, our houses are worth less. We're told how lucky we are for our houses to keep going up. Um, Final observation: the real boom was back in 2004. Back in 2004, that's when house prices were at their bubble, at their peak. And actually, from 2004 to 2013, if I go to the previous slide, they went sideways for like 10 years. And that's actually because it was running off this all-time overvaluation. And
Yeah.
this is the bubble that caused the 2008 crash because the same things were occurring in other markets overseas. So that's when we had the
Mm,
big bubbles. Um,
interesting.
yeah, David, just so I can catch my breath, thoughts on the last two slides?
Very good insights as always, John. I'm sure the people would appreciate it in terms of what you're saying. And but look, um, I think last time was heading down towards the 200 ounces, but
Yeah.
looks like as we get closer to the April data, it's actually starting to have a little peak back
Yeah.
up again, or it's kind of edging a little bit more towards the 400 ounces. What do you think is the cause of that? Or like, what is it because of the gold prices decreasing,
Yeah.
fluctuating? What do you reckon?
I feel like we're at the end of something. We're at the end of an era, a period of time. I think maybe COVID broke something, and which would make sense. So I think COVID broke something in our monetary system,
Mm,
and we're kind of living with. I think we're paying the piper for the COVID mistakes, the shutdowns, and these sorts of things. But but the tantrum has been taken out on the currency, not in house prices. So we're all poorer, but that's really an Australian dollar problem. That's what the gold price is telling us. So the gold price is shooting up. And don't forget, it didn't shoot up because of the Iran war. It shot up it's actually been shooting up since about 2015. And what that's doing is correcting for the kind of the overvaluation of the Australian dollar, like and the US dollar and the pound and the euro. All these currencies have been overvalued, and the gold price has been spiking to liquidate the overvaluation of currencies.
mm,
Um, and everything denominated in the currencies, like our stock markets, like our real estate markets, and so on. Uh, so I think we're coming to the end of maybe a period of time in terms of currency. Seems to be the end of a cycle. But what I think this is really showing us is that the Australian dollar has gone through a 15-year period of decline since 2004. We're at the end of that now. Is that 15 years? 20
2004.
years.
That's
22
about
years,
22,
right?
22
So
years.
we're at the end of an Australian dollar period of like decline, and real estate just got swept up in that. So, but Sydney has
Yeah.
also been a poorly performing ish market in that time as well. If you compare it to say Brisbane or Adelaide or these other markets which we'll come to.
Mm,
Um, yeah,
interesting.
I think there's been a debt liquidation, and the gold price has been readjusting the value of our currencies.
Yeah. 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 Okay. Yeah, well,
Um,
that's it certainly seems to be a changing narrative, and I wonder how much of that will change is because the market's ready for when the federal budget sentiment really kicks in,
yeah,
how that graph is going to react and move forward is going to be interesting. And let's say hypothetically, because right now you're comparing, so this graph is comparing Sydney house prices versus gold. Let's say, for example, if gold stays relatively constant from this point onwards, but Sydney
yep,
house prices continue to drop, how would this graph react to that? Is that moving more towards the 400 mark or is that more towards the 200 mark?
Mhm. Yeah, look, yeah, I mean, excellent question. I don't really know, but what I would expect is that
Exactly.
property prices soften from here slash gold
Mm,
prices go up a little bit. So I think we do get to 200 ounces. We're not quite there yet, but
okay.
I think we're as good as there. So I think we're at a market bottom. Look, it feels like a market bottom. The market's shit. The no children around, please listen. It
Equal
feels
terms.
like a bottom. So we're broadly there. Let's say in the next 12 months, this is a bottom, and I think that that's going to set us
Mm,
up for a like the next 20 years of being
mm.
another bull market in real estate. That's actually what I think is happening.
It's always bullish. Let's see how
Mhm.
the new federal budget changes, especially negative gearing and capital gains tax. I think there's
Yep.
a lot of headwinds in terms of that. So but yeah, well, I think we'll have to let it pan out. I reckon in 6 to 12
Yeah.
months' time, it will give us a clearer picture in terms of where we're heading, in that
Yep.
sense, because yeah, the market would have got the time to be able to absorb the information, be able to see how how
Mm.
how how it reacts. But certainly from a sentiment perspective, right now, investor sentiment is fairly low. Let's put it that way,
Very low.
because it's no longer
Um,
becoming a viable option in comparison to before, which majority of it we've already covered in our last federal
Yeah,
budget update
correct.
episode.
Correct.
So,
And anecdotally, as we were saying before, so I think this only tracks house prices. Rent prices, I think, have already started
mm,
to surge. And I think that
yeah,
we'll do another episode on this, but I think that the worst fears about the rental market will be realized, and we can see
mm,
some real evidence of that. Should we
cool.
compare the capitals?
Let's go through them.
All right. So the way we've sequenced this really is we're going to start with the most overvalued capitals, and we're going to end with the most undervalued capitals. So stick around to the end for where the buying opportunities are. Um, the way it works is that everything is compared to Sydney. So Sydney, like where gold was the anchor in the previous slide, Sydney is the anchor. So it's how does Brisbane in this case compare to Sydney, and Sydney is the anchor. But when the price when the line go this is Brisbane prices divided by Sydney prices essentially. When the line goes up, Sydney is overvalued, Sydney is expensive, and when the line goes down, Brisbane is expensive or Brisbane is overvalued. And this data goes back to 1979. So very, very reliable. Again, when you're looking at ratios, either ratios to gold or ratios to other capital cities, the beauty is you're seeing relative prices. So Brisbane is relatively expensive compared to Sydney, or Sydney is relatively undervalued compared to
Yep.
Brisbane. And everything just goes up and down. It never just goes up forever. Here we
Yeah.
can see, so we might be at the end of the Brisbane story. Like I feel like it's got a little bit of overperformance to go compared to Sydney, and then like stick a fork in Brisbane. Brisbane's done. We're already at these levels. I think you can see the cursor around
Yeah.
2006, 2007.
Yes.
That was when the
Correct.
Brisbane floods were, and that cooked the Brisbane market for quite a little while. We're back at those levels, or we're maybe marginally above them. So suggesting that it's going to go to those levels now. The what do they call it? The curveball here could be that Brisbane gets way overvalued. It might go down to this 1-to-1 line by
100%.
2030 for the Olympics, right? So there's a
Yeah. Yeah.
there's a real chance that Brisbane it becomes a major bubble. Right now, it's just an expensive capital city
Yes.
compared to Sydney. It's just a little bit overvalued, but it might become like like a systemic like banking risk if it keeps going, and it may, but right now that's too early to say
Yeah.
because there's still like I don't know. You're a little bit better connected than I am to Brisbane. I mean, what are the yields like? Can you still get better cash flow in Brisbane than you can in say Sydney, or is it about the same now or
I reckon
worse?
it'll be fairly close. I mean, depending on,
Mm,
oh, well, I guess depending on where you look at it. Again, it's markets within markets, right? So you can't really generalize as such.
Yeah.
But Brisbane property prices have also gone up relatively big in comparison to the rents that's been getting. So I reckon,
Yeah.
if you're talking about expensive suburbs, the yields are probably catching up to what the Sydney expensive suburbs are also doing. So we're
Yeah.
talking about gross rental return yield here.
Yeah.
Whereas the cheaper suburbs, like the Logans that we used to be able to get 5%, 6% easy, you can't get that anywhere now. Basically, it's more
Yeah.
towards 4% or even lower, right, to
Yeah.
a certain degree. So yeah, so I think it's heading towards that is yeah, I think I'm pretty on the same line as you at the moment, John. I reckon there's a little bit more to go to Brisbane because of the Olympics incentives and because of the
Yeah.
infrastructure boom that's still coming. More buildings and more opportunities, more employment, more population. And don't forget, Brisbane is still proving to be one of the ideal locations that people want to migrate to. We
Yeah.
have a lot of net migration losses in Sydney and Melbourne, whereas
Mm,
people are moving into Brisbane for the warmer weathers. Gold Coast and Sunshine Coast are beautiful places to live in for families and great lifestyle, etc., etc. So that component isn't going to change. So I think from a long-term perspective, that is always going to be there. But in the short term, like looking at that graph, it's literally from what, 2018, right? Around 2018, it's
yeah. Yep.
the chart's being skewed, and basically it's done a 180, right?
Yeah.
It turned from Sydney overvalued, and then the trend has been continuously moving towards Brisbane overvalued. So from 2018 to today, 2026, it's been a good 8 years of really good bull run, in that case. Given all the
Mm,
headwinds that's been going with all the changes in negative gearing, with all the changes in CGT, I reckon all markets will experience some sort of slowdown, but it's just
yeah.
how much slowdown it is. Obviously, the Sydney and Melbourne markets primarily will get hit the most because of the higher value.
Yep.
Brisbane probably less so because they're still, like I said, the leading up to Olympics might still give a little bit more room to be able to grow, but we are pretty much at the end of it as well. Like it's just going to be down to a single digit. We're
I think
probably
so.
not going to see massive, massive upside swings like what we've seen for the last 8 years or so.
Yep. Yeah, I was chatting to a potential client, a
Yeah.
buyer, and he was looking for a trophy home in Sydney, but he lived on the Gold Coast, and he
Mm,
wanted to relocate his family to Sydney. And I'm like, oh, you've done. And I was sort of saying, oh, you've done very well by being, a Brisbane guy, and he's like, yeah, but I'm ready to Sydney where the next action will be. So I thought that was interesting. He's like, yeah, okay, but Brisbane's sort of done now, and he was a Brisbane guy. We'll
interesting.
see.
Okay.
We'll see. We'll see. Definitely, like, even if, let's say we're a year early, David, by saying,
Mm,
oh, the Brisbane's over, even if we're a year early, like in the scheme of things, in this chart that goes back to 1979, like basically we're there. Even if we're 6 months, a year early calling it, we're basically there.
yes. Yes.
Um, Now, the other most overvalued capital is Adelaide. Now, Adelaide, it's interesting for me, Adelaide, and I feel like a lot of Victorian money is going there. So, like, if you're in
Mm,
Melbourne and you don't want to kind of invest in the Socialist Republic of Victoria, where do you invest? And I think a lot of that money is going to Adelaide, right, where you'll be treated a little bit better. When we last had this conversation, we thought Adelaide was bottoming out and maybe was going to go back to Sydney, but
still
it's been
continue to go
outperforming
strong.
Sydney for the last 12 months.
Mm,
I think supply is still tight. I'm not really sure what's driving it, but I wouldn't be touching Adelaide. I think Adelaide probably is going to be going to the 150. Like it probably has more to run. In fact, I'm sure of it. Like you can see it outperforming Sydney at the moment, and it'll probably get to that line and then bounce off. But it's established. It's more expensive than Sydney historically right now, and
yeah.
unless you've got there's a strong narrative that you can think of that I can't think of, um,
What was the
Adelaide
reason
will
why it went why it
overperform.
was so overvalued in 2009? That was the last time when it was at 150%.
Yeah,
I
I
wonder
think it's
what.
because after the 2008 crash, Sydney just
Okay.
got cheap. So
Yes.
where is all the leverage in a deleveraging? Where's the leverage? The leverage is in Sydney.
Yes.
Um, And so I think that when Sydney was deleveraging,
Mm,
Adelaide was just a safe haven in some respects. So I think Adelaide will outperform Sydney for another year, maybe, but
okay.
I think the Adelaide story might be. coming to an end as well. But good run for
Mainly,
those that come in.
yeah, I think so. I think so, definitely. From again, this is looking like from about 2017 onwards, similar time frame in terms of the Brisbane story
Yeah,
as well, right? So it's kind of had
yeah.
that has that leg of growth as well over that period of time. But
Mm,
ultimately, yeah, I think Adelaide had the affordability story over those years, similar to Brisbane. It's like
yeah,
all the cities are just doing their catch-ups, basically,
correct.
over that period of time. So Adelaide has been doing that and has been one of the best performing alongside with Brisbane in the last, I don't know,
Mm,
couple of years, I have to say, like ever since I think 2021, 2022, it started booming like crazy, basically.
yeah,
So,
yeah,
um, but yeah, I don't know what else is driving there, unfortunately. Not don't know that market well enough to be able to comment. But yeah, I think that affordability story is probably potentially
yeah.
coming to an end as well.
And sometimes, we're looking for a story when really the only story is Adelaide was too cheap and it
Mm,
had to run that off. I mean, I know I sound like a kind of a cycles guy, but all the economic energy goes to where the undervaluation is. Right now, that's Brisbane. Sorry, right now it was Brisbane. Right now, it's Darwin,
was
actually,
Brisbane.
which we'll come to. And so that energy needs to run off and then it'll go somewhere else. So, all
Yes.
right, just going to try
Cool.
to get through these nice and quick. Perth is a super interesting market because it's sort of the other market after maybe Brisbane that a lot of the smart money's been going into.
Yes.
Um, and I think Brisbane is probably 60 or 70% of the way through its boom, but it's not over yet. It's still got quite a bit of room
Between
to like
Perth and
it's in
Melbourne.
sort of slightly overvalued territory, but the
Mm,
cycle's not over yet. Like this is
mm.
going to run for maybe another 2 years. Whereas I'm kind of comfortable to say that Brisbane might be kind of at the end of its, valuation cycle. Adelaide as well. I think Perth's got just a little bit more to go. And Perth doesn't kind of taper out. It swings violently, gets quite overvalued um, before it gets undervalued. So it's a bit more money to be made in Perth.
Massive swings, ups and downs. I think we all know it's the mining
Yeah,
capital of Australia, right? At the end of the day.
correct.
So, but I think one common thing between Sydney and Melbourne or Sydney and Perth is that they're both not really good at building new houses, basically. So there's always going to be a
Right.
supply issue in
Mm,
terms of new supplies. Whereas if you compare that to Melbourne, for example, Melbourne people or
mm,
Victorian people are really good at building houses. So we have less of a housing supply issue.
yeah,
So, I think that forms part of the narrative in terms of Perth as well, in terms of why there's more room and more up-leg room in order for price growth to still to come, just because there
yeah.
simply isn't, they're not building enough and they're not building it fast enough.
Hmm,
Kind of similar story to Sydney
yeah.
to a degree. So yeah, so look,
Interesting.
I tend to agree with you. I do think that Perth still got a bit more room to run. We thought that was the end of it, maybe probably not the last one or the episode
Yeah,
before, maybe 12 months ago ish. We reckon that might be
yeah.
it, but looks like it's got the second leg again. Second leg
Yeah,
coming
that's
through,
right.
right?
It's a bit like Adelaide, where it had this sort of pause, took a
Mm,
deep breath, and then it's like back to the races.
back to
There's
it
still a
again.
lot more. Yeah, I mean, one of the things that's interesting, and this is an obscure reference, but I got this kind of thinking from a guy named Mike Maloney. He's a gold guy in the US. He's been doing this for decades. This kind of the ratio approach rather than the kind of the nominal pricing
Nominal.
approach. But what he always says is the bigger the overvaluation here, the bigger the undervaluation becomes. So
Mhm. Okay.
this, so what you'll probably find is because this over, let's talk in terms of Perth. The Perth's undervaluation back in 2021, 2022 was so undervalued. It has to run that energy off, and it's probably going to get more overvalued than it was back in 2007. So is this the floor? Well, probably not. It's probably going to become a lot more overvalued than it did back in 2007. It's probably going to break this line in the same way this broke this line. The last peak was bigger than the previous peak, so the next trough has to be bigger than the previous trough, if that
Yeah.
makes
Okay.
sense. So I
Hmm.
suspect we're going to have a lot of overvaluation from Perth. So
So
maybe
another
he's
one
got
to 2 years to go, do you reckon, John?
yeah, yeah, yeah. more than 1 year, I'd say.
Okay.
Um, yeah, interesting. Hobart. So Hobart is overvalued compared to Sydney. You can see the line of best fit definitely going towards Hobart. Hobart's been like a good play since, let's say, 2017.
Mhm.
Most capitals have outperformed Sydney since 2017, but actually seems to be getting another lease of life. And you mentioned some clients of yours are getting into the Hobart market, and you can
Starting to
see
look
it's
at the
starting
Hobart
to over.
market. Yes, that's right.
Yeah,
Yeah.
not a market I look at terribly. I mean, um, for right now, I think Sydney's probably slightly better value, but not by much. And yeah, I just don't know much about Hobart, to be honest.
Kind of that equilibrium point to a degree. I guess people looking at it because of the fact that Hobart hasn't been moving at all for the last couple of
Yeah.
years. I think partly because it was overpriced, like you said. Back in 2020 to 2022, that period of time, Hobart had a really good run, right? But now obviously it's starting to lose off that steam and market's doing a bit of catch up, rent's doing a bit of catch
Mm,
up. So therefore, when all the other markets have pretty much done the dash, when investors try to chase something with a decent yield without a huge price tag. Apart from Melbourne, Hobart is probably the other one that they're looking at right now in order to make the
yeah.
yield play work at the moment, or closer
Yeah.
to make a yield play work. So that's one of the
Okay.
reasons why I think people are looking at that market.
Mm,
Um, but yes, again, yeah, I don't know that market well enough to be able to comment either. So
yeah.
but it seems to be at that equilibrium point at the moment by the looks of it.
Yeah.
It's not quite overvalued and it's not quite undervalued as well. So it just sits there.
Yeah. Yeah, I tend to agree. I mean, I remember Propertyology, I want to say they were big
Mm.
advocates for Hobart back in 2015, 14. They were absolutely right. I'm not really hearing people talk about Hobart at the moment. It doesn't seem to be sort of, this obviously undervalued capital. It just seems to be somewhere in the middle. Probably a little bit expensive, but safe, I would say. Canberra, probably balanced, um,
Yep.
maybe cheap, but I don't have much to say on Canberra other than it seems to be right in the middle. Right in the middle.
I
Thoughts,
suppose it's
David?
benefiting a little bit. Yeah, like I think it's also an equilibrium point as well,
Yeah.
to a degree. But it was certainly benefiting from all the government spends into, public sectors, hiring more people in the public sectors. I
Yeah.
assume Canberra was a beneficiary of that, as that's the public sector central of Australia.
Hmm.
So a lot of the wealthy public sector people employed there would be probably living in Canberra.
Yeah.
But it was really expensive beforehand, right? Like, getting towards that
Yeah.
2021, 2022, where we know Canberra was going up like crazy. So now it's lost off a couple of years of steam. I think at some point in time, it will probably continue to shine as people put their legs and set their foundation for their family to purchase a property in
Yeah.
Canberra. So yeah, it's gonna come along. It's gonna hum along as well. But I don't see short-term incentives at the moment to kind of be investing there.
Yeah.
At least nothing that
Yeah.
I'm aware of.
Yeah. I mean, Canberra moves a little bit based on who's in power at the federal level.
Yeah.
Um, so, if you have a political view on, who's going to come into power or who's going to go out of power, you might want to play the Canberra game, but it's probably above my pay grade. Who else? Okay, all right. So now we've gone from the overvalued capitals, and we're sequenced it that way through to
Yep.
like balance, let's say Canberra, maybe Hobart, to the undervalued. Now, the one thing that's changed is the last two, and you can guess what they are, Darwin and one other, have switched. So this is the second most undervalued capital. And we were saying back here, Darwin is Perth 3 years ago. Like it is
Yep.
undervalued, and it's still undervalued, but it is caught up super quick. So, but this market's got years to go. Darwin is undervalued compared to Sydney. A lot of smart money is going in there. I think you can still get a lot of yield. The question is, do you want to invest in Darwin, or is this a market that you're happy to let go through to the wiki? But depending on how sort of fluid and nimble you are, This is one of the areas of significant undervaluation, and it's on a tear. It's on a tear.
Risky
It's like
play.
doing 15 to 20% a year.
Yeah, we know it's going to like we always know that the Darwin market is a risky play to a degree, but it was certainly too undervalued at a couple of years back in order for investors to really ignore it, right? When you can
Hmm.
get a house that still sits around 6 to 7% yield, that's like Logan back in the days before
Yeah,
Brisbane all boom, right? So,
correct.
but
That's right.
yeah, but Darwin's even smaller from an engine capacity perspective. I think it's even smaller than the Townsville, to be
I
to
think
be
you're right.
honest.
Yeah.
So. Yeah, so like we've always said this, tread Darwin carefully, because it is a very, very small place. Like we were joking previously, if a big buyer's agency just decides to buy there, right, and bring all their clients there, it is going to drive Darwin up, basically.
Yeah.
It's basically as sensitive as that. So while the current story seems to be promising, that music can stop at any time as well, especially
Yep.
now that the investor lending story based on the federal budget is going to basically come to a bit of a halt.
Hmm.
Everyone's borrowing capacity is going to take a bit of a shot. Investors are going to be looking more cautiously and also invest more cautiously. That's not to say Darwin's not a place to invest because the yield probably still stacks up. But then again, it's just, you got to look at the fundamentals
Yeah.
as well.
Yeah.
So, it's done fabulously in the last 2 years. How much more to go at this point is anyone's guess. But yeah, do your own due diligence and research before you obviously
Correct.
pull the
Correct.
trigger.
And your returns there than Sydney. I think you were getting a 7% yield on the average property. About 7% is
Previously,
amazing. I think, yeah, but it comes with risks. It's a smaller, less liquid market than Sydney. You're more likely to get some natural disasters like the odd cyclone
yep.
or torrential rain. You just won't get those sort of things in Sydney. Sydney's way too boring. But Darwin is where a lot of smart money is going. Yeah, I think you can still make some good money over the next, say, 5 years. It's got a couple of good years left.
Okay.
Um, and to finish up, the most undervalued capital, we're talking about generational opportunities. When was the last time it was this cheap? Back here in 2003, so
Sure.
nearly 23 years ago.
20 years, 23 years.
Melbourne is cheap. Melbourne's cheap, and actually, it looks like it's getting cheaper. So it's
Getting
probably,
cheaper.
it's probably got to come up here a little bit further. I mean, maybe it might be cooked, it might be ready to roll, but I feel like isn't there? I think there's an election later this year, and maybe
Mm.
that's in like let's say 3 or 4 months' time. That's probably the time frame for this chart to reach its levels and to turn around. So we'll see. We'll see.
So it's
Um,
not the bottom yet, John. What you're saying is there's more room for further price reductions
yeah,
for anyone looking at it.
I think
Um,
so.
and and and
I think it's got further to go. Yeah,
mm,
yeah. But look,
but certainly, yeah,
if you're a scavenger and if you're a value investor, let's say a bit more politely, Melbourne's a great opportunity. It's actually not. It's not really at these. It really is, isn't it? I mean, it's been slightly cheaper in the past, but not much. I mean, you'd be getting it in at great levels here.
yeah, yeah. No, absolutely. But look, it's still the most, I guess, from a relative term, affordable capital out of this
Yeah,
round at the moment. Whereas last time I think it was Darwin
correct,
was the one. So
correct.
Melbourne's took the crown this time in terms of being the most affordable or capital relative from the relative terms out of all the capital cities. And no
Yep.
wonder where people are looking at getting value and try to find a balanced yield, etc., is looking at Melbourne just because there's so much value, so
Yeah.
many properties that you can pick right now. But that's not to say it's going to turn around quickly though. So I think with anyone getting into the Melbourne market, the expectation needs to be it's a long-term hold, and it should be. Like, any good kind of good investing,
Any.
you should be
Yep.
looking at 20, 30 years anyway. And during that period of time, you know, like John, like what you said, this is a generational opportunity to be able to sweep up some
Yes.
decent, decent quality assets at literally bargain sales price
Yep.
or close to the bargain
Yeah.
sales price. There might be a couple more years, but I highly doubt anything that's it's going to go down even further because it's
Yeah.
already pretty much at that floor. So how much further can it drop? Like,
Yeah. Mm. No, I agree. And look, so Melbourne's. I mean, obviously, do your research. I think there are. I think it's
yeah,
quite. I think there are some barriers to entry getting into Melbourne in terms of land taxes and stamp duties and stuff like that. So
yes,
you do your research on that. But just in terms of like sheer relative cheapness, or like it's very compelling at the moment. But look, to summarize, I'm going to stop sharing here so we can wrap it with a chat. But in addition to Melbourne being the cheapest, followed by Darwin being the second cheapest, that means that the third cheapest capital is Sydney, and Sydney is also Sydney has been basically outperformed by every major capital since 2017. Um, that was 9 years ago. So Sydney is really well placed. And as I remind you of my property developer mate who is moving from Queensland to Sydney, partly on the basis that there's more value here. It's quite interesting to see what happens in the next couple of years. I don't think Sydney is at its bottom yet. I still think that it's really suffering
probably
in the
starting.
wake of the yeah. But when we zoom out to decades and we're looking, and this is what makes this analysis so interesting and so contextual, is because you can look at it in terms of, I mean, on the x-axis, you can't even see what year you're really looking at. It's zoomed
Yep.
out that much, which is so valuable, I think, that you basically know when you're at your turning points. So Sydney feels like it's approaching its turning point, and by the end of the year, we can maybe take another view. But good buying for Sydney, I think.
Yeah, no, I think there will be great opportunities to be buying quality assets in Sydney. The only problem is whether people are willing to offload them or not, because again, it depends on whether it's a property investor or owner occupier, right? Um, I think the biggest challenge for Sydney as we get into the winter period as well, which traditionally was also a quieter season, is I'm not sure whether there will be much of a good stock or how much good stock there will be available on the market.
Yeah.
There will certainly be flooded with a lot of potentially second hand or second tier, third grade kind of properties
Yeah.
on the market. But I think certainly when I look at the amount of money that you can purchase in units in comparison to, like buying something like and maybe not even unit, let's say townhouses, villas, duplexes, these
Yeah.
type of assets, when you compare that to the rental yield that you can get moving forward, like they are still very, very good in, in,
Yeah.
in, in relative terms. So I reckon townhouses, duplexes, villas, apartments, low rise apartments, I should probably point out, these are going to be the top performers. It might be the first one that's going to drive the turnaround of the city market in the next 6 to 12 months,
Mm,
potentially even longer in the long run, because houses are now starting to call back because houses have done way too much right now.
yes.
And now it's only a natural progress to kind of reverse that cycle and for the prices to come back. Whereas, for people who can't afford to purchase those properties, which we said multiple times on this podcast, right? Especially now that with negative gearing gone, your borrowing capacity might be reducing by 15-20%. So what would people look at? Naturally, what they can afford. Well, what can they afford? I guess people can try to push to purchase an asset that they can afford at most. And, for a family looking at upsizing, if you can't get a house, you'll be looking at duplexes, you'll be looking at townhouses, you'll be looking at
Yeah.
villas, whatever that you can get your hands onto it. Those are probably going to be the
Hmm.
ones that's going to continue to do quite well in the long run. And then ultimately for those investors who's looking at returns or focus on yields and gross yields, the low rise units might still be able to give you close to 5%, depending on where you're looking at 5% or even,
Yeah.
a high fours. That is pretty good gross return in city markets today.
Yeah.
And you can still get units around a 600K as well. So,
Yeah.
that's like, yeah, that's like, these type of assets adjusting to the new federal budget type of um, strategy, like with no negative gearing, capital gains tax being smashed,
Yeah.
people are going to be out of pocket with no negative gearing, no government subsidy in order to be able to help you hold these assets. So any kind of assets that's going to have a good rental return or good yield is going to be more critical than ever
Yeah.
moving forward. So,
Correct.
yeah.
100%. Yeah. So, I mean, what's the yield on a house in Sydney these days? Still 3%.
Well,
I mean, that's It's terrible. So that's all evening out. If we were to do the ratio rents, I
That is go
mean, rents would
evening
be
out.
going up, prices are coming down, and the rents, the yields are normalizing. So
Yep.
we are in like things are changing again.
Yep.
Tectonic plates are moving. We're at the end of a period of time where the opposite of the previous trend is now going to prevail. So it's an interesting time.
Yeah, 100%. All right, John. Well, thank you so much again for putting together the slides. As always, I'm sure that our listeners got something out of it. Hopefully, everyone's got some insights to take away, and I'm sure the next 6 months going to look very, very different. So, when we do the slides again in 6 months' time, it might look very interesting. So, looking forward to that chat again at that point, John.
Likewise.
All right. To our listeners, thank you very much for joining us. And look, if you got any questions, feel free to send it to us. And don't panic, I guess. It's business as usual at the moment. Like, we're still seeing investors looking at purchasing properties, although, different type of assets they're looking at. But there's still good opportunities out there. Just be very cautious in terms of what you're getting. And, I guess our number one general recommendation is not to buy off the plan units or off the plan brand new stuff. Don't buy anything brand new and shiny, I guess, let's put it that way. Hopefully, if anyone's been taking, want to have at least one takeaway, that's probably what I would recommend. Because yeah, ultimately, well, we can actually do it. We can talk about that again in another episode, but
Yeah.
I'm sure we've harped on a lot. People will stop, don't want to listen to us anymore. So, all right, until next time, we'll see you guys in that episode of Spark Your Fire. Cheers, John and David.